Kevin Warsh is all set to take over from Jerome Powell as the head of the Federal Reserve. Now, much has been made of his belief that interest rates can be lowered further. That's in part because of his optimism about structural productivity gains, but also because he thinks the Fed should shrink its balance sheet, and the effects of that can be mitigated by lower short-term policy rates. However, we have to remember that Kevin Warsh's vote is just one amongst 12, and not all other members share the same views. And that was highlighted at the most recent Federal Reserve meeting, where we had 3 members who wanted the Fed to more explicitly acknowledge that there were two-way risks to policy rates. After all, inflation has been above target for the past 5 years and looks set to push above 4% in the near future on oil prices. But the Federal Reserve has a dual mandate, and the jobs numbers have undoubtedly cooled and wage growth has certainly slowed. And that means there's more of a squeeze on spending power that risks weaker future growth. And at the same time, less demand impetus may well help to dampen price pressures that are outside of the energy sector. The Federal Reserve will undoubtedly talk tough on inflation in the near term, but if we can get an agreement that allows a reopening of the Strait of Hormuz and the return of the flow of oil and gas, then we still think interest rate cuts are more likely this year than interest rate hikes. And you can access all of our research and our forecasts at our website think.ing.com.